welcome to Market Domination. I'm Julie Hyman, that's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Nvidia's earnings are very important because in general, if you look at what has been critical to S&P's rise, it's been big tech, and Nvidia is a critical component, probably the most important component of that subgroup of just 6 stocks.
Nvidia is growing and evolving. Could it have a short-term impact on the market here? No question. Do we own it? We own it. Are we staying in it? Yes. Nvidia is one of those names. I think if you hold it over the next decade, you're going to be very well rewarded.
While some of the headline numbers were light of what was expected, Target's clearly making progress. Its same-store sales was down less this quarter than it was last quarter. Plus, it showed progress on its gross margin.
We've got 1 hour to go until the market close, and we're taking a look at the major averages, although today I'm actually going to start with Nvidia. We got to get to the major averages in just a moment, but happy Nvidia earnings day to those who observe. We have the shares pulling back from the record high where they closed yesterday. We're going to dig much more into Nvidia, but as we've talked a lot about, and we're going to talk more about, the stakes are high with the shares up 90% year to date. So let's get to the major averages here because there's a lot to talk about when it comes to them as well. We are seeing the Dow go to the lows of the session here, off right now about 0.6%. The S&P 500 off now about 0.5%, as is the Nasdaq. What's going on? It looks like it is the Federal Reserve minutes, which were released just about an hour ago, that seems to be to blame here. In those minutes, which were from the meeting that concluded on May 1st, participants expressed willingness to potentially tighten policy further if we continue to see inflation readings that are not showing much relief. And on top of that, we had Goldman Sachs' David Solomon speaking in comments at Boston College and saying he expects 0 rate cuts this year. And he says the risk of real and palpable economic slowdown is now bigger than it was 6 months ago. Now, stocks perhaps not down more because those Federal Reserve minutes and that discussion occurred before we got the latest CPI report, which showed a little bit of relief on the inflation front. So all of that said, we are seeing that pullback. I want to get to sectors here real quick within the S&P 500. Energy down the most right now, consumer discretionary, materials, utilities, pretty broad-based sell-off. In fact, the only group that is higher right now is healthcare. Josh?
Julie, let's get right to it. Nvidia earnings are just over an hour away. The report Wall Street has been waiting for, of course, our own Dan Howley is here with what to expect. Dan.
Yeah, I think obviously the big news here is it's going to be the top line and bottom line numbers, but then the guidance going forward. And I think, after seeing the massive jumps that we had seen in the prior quarters, the big news is going to be how did they do this quarter, but then what's happening next quarter? And what does that mean as far as Wall Street's interpretation, right? Because we're going to start to lap last year where everything started to really blow up. And we saw these, 100%, 200% gains, right? I think last quarter, the revenue was around 21.6 billion, something in that area. Nearly for that one quarter, nearly the entire revenue of the year prior in one quarter. So we're going to have to see what that means for this quarter, and then moving forward, those comps, what that looks like and how Wall Street responds to that. Are they going to say, well, look, you're not doing 300% growth. I don't know what to tell you. We're out. Or are they going to say, okay, you're still the odds-on leader in AI? And frankly, they are still with the hardware that they have to offer as well as the software moat that they have.
Now, something you and I have been talking a little bit about is what these chips are being used for within AI. And there's sort of 2 phases of AI that are important. There's the training, and this is something I think we talked about a little bit yesterday, the training where you're building these large language models in the generative AI, right, where they're learning. Mm-hmm. Then once you get them trained, then you have inference, where they actually start working, they start making connections. I'm saying it like it's a brain, but who was it who said this week we don't want to anthropomorphize them too much? Was it Satya Nadella who said that? In any case, where they start making forecasts and making thinking, for lack of a better word, right? So The thing is to sort of figure out where NVIDIA fits in. It fits into the training, we know that.
Sure.
And then what happens?
Yeah, I mean, look, the training is really the heavy duty processing that these companies need these chips for. If you're going to be training, you need that kind of hardcore performance. Inferencing, you still need that performance, but not as much. The data heavy side of training requires these big chips, but you can use less powerful, more efficient chips for inferencing itself. That's not to say that you can just like pop out a laptop chip from like, my MacBook and start inferencing. That's crazy, but it doesn't need to be these kinds of heavy-duty NVIDIA chips. And so I think as we start to see companies go from training to inferencing, what does that then mean for NVIDIA overall? Does that mean that companies will start opting for less powerful and more efficient chips so that they're not consuming as much energy and not paying as much when they sign on with cloud providers? I think that's a question that is really important for NVIDIA to answer.
Let me see, we were talking to Dan Niles on the show, smart guy, longtime tech investor, and NVIDIA fan. And we asked Dan, that when you're talking to your clients and they want to ask you about downside risks, what do you tell them? He named a few different points, but then he said something interesting. He said one risk he talks to his clients about is how, NVIDIA, yes, it's a chip giant, but the real secret sauce is the software, CUDA. That's what's locking the customers into the silicon. And his point being, of course, there's these efforts to develop these, open source alternatives. Dan Niles did not see that as a near, even intermediate term risk. But how do you see it?
I think that is something that a lot of companies are keeping in mind. And so I think it's important you can look at it almost from how the cloud evolved over time, right? When the cloud computing really started taking off initially, it was, well, let's sign up for a cloud provider, right? And then you saw companies say, well, I don't want to get locked in with one guy. That's just not good for me. That's not good for competition. My clients might want something else. Customers might not want to pay for this particular client. Or maybe I don't want to have all my data sitting in this one place. Maybe I want to have it on another provider. So now you have what's called a multi-cloud strategy, right? It just makes more sense to disperse your data across different areas. And so I think you can kind of look at it in that same way, where you initially go, okay, we have these NVIDIA chips, they're great. You're seeing the hyperscalers, the Microsofts, the Googles, the Amazons, they spread out, right? They have their own chips now that they're building, their own training and inferencing chips. They have NVIDIA, they have AMD. I'm sure they're using Intel as well at some point. But I think that the effort is going to be this more open source idea. And yeah, CUDA is the software moat, right? Once you build on CUDA, you're building the software for that particular architecture.
You're locked in now.
Yeah, and so now there's ideas of, well, how can other companies maybe open that up so that you don't have to just rely on CUDA. You can get beyond that.
Other chips that can work with CUDA even. Just quickly, a little perspective, a pause for some perspective here. We have two pie charts because we were looking a few years back at 2021 at what the revenue breakdown looked like for NVIDIA at that time. And by the way, NVIDIA was the Yahoo Finance Company of the Year back in 2016. Yeah. But this revenue under $17 billion, and gaming was still 46.5% of the revenue, 40% was data center. Yeah. Fast forward to 2024, and fiscal 2025 for the company, but actual 2023, fiscal 2024, excuse me. Revenue, $61 billion, and 78% of that data center.
And it's not that the gaming side is losing. I mean, maybe during that period, the 2021, where we saw the spike with COVID, people going out and purchasing cards, and then we also saw the crypto kind of surge was going hard at that point, people buying those up. And then on the secondary market, they were selling for like, $1,500 when, I mean, I'm a gamer, I couldn't get that, man. But yeah, and then you look at how it's kind of changed to now, where the gaming side it's cooled off a little bit. People still are buying those chips, though. It's still I mean, look, if you look at a breakdown between NVIDIA, AMD, and other, when it comes to dedicated chips, NVIDIA crushes everything, right? So it's not as though gaming isn't an important business for them.
It's still
just
like 20% of that pie.
It's just that data center has exploded.
Absolutely, yeah.
It's not that the others aren't growing. It's that data is growing so much more.
Bonkers.
Yeah. Dan, we're going to check in with you again. Thanks so much. Appreciate it. Although expectations for Nvidia's first quarter results are high once again, topping those estimates has not necessarily translated into big stock moves in recent quarters. Josh Schaefer is here with more on that as the bogey's gotten a little bit tougher. Right? I'm totally mixing my sports metaphors there. But it's gotten harder to beat.
A for effort.
A for effort, right?
Whatever that
That's
means.
a metaphor we know. A for effort, right? But for Nvidia, really the last couple quarters we've seen that beating and raising, as they have been doing, hasn't always necessarily meant that the stock pops, like most stocks pop in that scenario. So what you're looking at here is the implied options, or the implied move for the stock after earnings. According to options, this is from the Friday going into earnings. That's in purple. The blue is the actual earnings reaction. So today we're looking at perhaps an 8.5% move, closer to a 9% move now per options. But when you look at these blue and purple lines, you see they don't actually line up that much. So really the broad takeaway here is what the expectations were going into the report don't quite matter that much once we get to about 4:15 this afternoon, and it hasn't really been that accurate
In other words,
pricing it
we
in.
have no idea what's going to happen.
We have no idea. And then the other takeaway from this graph is that in Q2 and Q3 of last year, Nvidia did beat and raise, and the stock didn't even go up, right? And that is something that could very well be a reality tonight into tomorrow, right? The stock is at an all-time high right now, or just off an all-time high, and up over 90% going into the print. It's always something I think just important as investors to keep in mind when you're kind of staring at your screen later tonight or maybe tomorrow morning and you read the commentary and it all could seem relatively positive, but the stock isn't in the green. Well, maybe there was just a massive rally leading into the print, and it's just not enough to move a stock that has rallied over 200% over the last year. It's something we've seen on earnings over the last couple quarters.
We're going to find out soon enough. What about the broader market, Josh?
Yeah, it's going to be interesting to see what happens with Nvidia in terms of the broader market, right? So we know obviously it is a large portion of the S&P 500 at this point, the Nasdaq 100, and many of the major indexes, and it is able to move those indexes quite significantly. So we're looking at your screen here is just simply the weighting of the company in the S&P 500. It's about 5% of the S&P 500, over 6% of the Nasdaq 100, and so on and so forth there. So essentially, if you see a big move in this stock tomorrow, it might also mean that you're seeing a move in the major indexes. And that's not even really getting into the fact that we know if Nvidia says something about AI demand, that means X or Y for chips as well, right? So if they're saying positive.
And now for utilities,
Right.
maybe for hyperscalers, like there's
it could be very
yeah.
broad, and I think that's the main thing I'm interested to see tomorrow, as you just mentioned, Julie, is sort of the utilities energy trade and that real AI broadening that we've had. Does that now trade on Nvidia earnings too? I don't know, but it certainly could to some extent, right? And it's going to be interesting to me, something to watch in the market action tomorrow.
Find out.
It'll be fun.
It will be fun.
I'm excited.
Thanks, Josh. And be sure to tune into Yahoo Finance tonight and tomorrow. Dan Howley and I will be speaking with NVIDIA CEO Jensen Huang after the earnings call, so you don't want to miss his comments.
Stocks near the lows of the day as investors wait for the results of Nvidia's first quarter earnings. It's coming up after the bell. Expectations we know are high for the tech giant, and the stock's move this year accounts for a quarter of the S&P 500's gain, according to Deutsche Bank. Joining us now is Will McGough, Director of Investment at Prime Capital Investment Advisors. Will, good to see you.
Thanks for having us.
So let's maybe start there, Will. Nvidia after the bell today. What are you expecting? What does it mean for the market?
I just want to know who's not talking about NVIDIA. I've been in New York for a couple days, and all of our meetings, AI is the buzzword. So it's all eyes are on NVIDIA today. As you just showed, Josh, it's going to drive the market with 5% weight in the S&P. I don't specifically run our stock portfolios. I'm a multi-asset guy, but our PMs are looking at operating earnings. They're trying to see if competition's going to drip in a little bit, take away a little bit of market share. And so that's what our guys are looking at. Of course, we own NVIDIA like everybody else, and we'll be observing it just like everybody else.
Well, and how are you thinking about it, or are you thinking about it from a macro perspective, right? Not just NVIDIA specifically, but the whole AI play.
It's, as you just mentioned with utilities, it's coming down. Utilities is like a 2 or 3% weighting sector of the S&P. A lot of folks think it's old economy getting bid up with utilities, but it's really a tech-driven move here. So I think it's got huge implications across the economy. It's could command multiples higher. For example, last year it was no earnings growth. It was all multiple expansion. Earnings season's coming through this year with multiples staying about the same. So could we enter a period where multiples could be rationally viewed higher when everybody else thinks they should come back towards average because of AI? I think that's something that investors need to think about.
And well, when you think about Nvidia, do you think about it now, and do your PMs think about it as kind of a gauge, a broader barometer, rather than just, does it say something more than just about Nvidia itself at this point?
For sure, you have to think about trends, and AI as a trend is driving speculation. What could be market breadth with small cap stocks getting bid up. It could be AI with large cap growth, Mag 7. The US economy, stock market's like a super tanker. It takes a while for these trends to percolate. They go on for a while, and it takes a while for a new trend to develop. So you have to be aware of these trends in the market to ultimately position your portfolios.
Speaking of trends, what is the inflation trend? That is the other big question right now that's gotten overshadowed by Nvidia. We got a little bit of a hint of it in the Fed minutes,
right,
where participants said, well, maybe we are going to need to tighten more. The market seems to be sort of shrugging that. I mean, how did you read those comments? They're a little dated.
So, yeah,
sure.
I casually checked in on it before I was coming here to prep, and it was more hawkish than I expected.
Yeah.
As most investors in this market's down a little bit today because of it. The Fed likes to float speakers to have different theories out there to see how the market may react to cuts or no cuts. And we're kind of in a camp where we may see the unexpected of a hike if this rate, inflation.
Even though Jay Powell told you he basically took that off the table.
We could see it. I mean, it's what's going to happen if inflation stays stickier and rates stay higher, which I think is a good thing, ultimately, to have a higher rate environment. We haven't seen it in gosh knows how long. So we can kind of get back to the old regime from like the 60s and 70s where you've got competition for capital with debt investors and equity investors is healthy. We deal with a lot of retirement investors, so having cash rates higher is a good thing. Capital market assumptions increase higher when risk-free is higher too. So I think higher rates are good. We're just conditioned to a bias of a low rate environment that's changing, and a lot of folks have grown up in this industry with low rates, and that's all they know. So we have to see how that's going to affect, cyclical and secular trends going forward too. But that said, I think, McDonald's has come out with the value meal. Target's going to reduce prices on 3,000 items or something like that. So we could be at peak inflation, peak rate move. And we could just be talking about all this, could just be a whole bunch of nothing. The old adage, sell in May and go away, I think it's a good strategy this year. It's we got all this news baked in. Markets should just settle down over the summer, enjoy your summer break, because when we come back in the fall, we got an election. So all that volatility
That's
is
it. I'm taking off for the summer, Will. Thank you. Appreciate the green light on that. Thanks so much for being here. Appreciate it. Well, we're just getting started here on market domination. Coming up, shares of Target are sinking today after it missed on earnings. We'll check in on the retail giant and a few other trending tickers on the other side.
And at 4:30 Eastern Time, it's the latest edition of our new show, Asking for Trend. We'll be diving into the latest numbers from Nvidia and breaking down the moves that will be affecting your money.
And be sure to tune into Yahoo Finance tonight and tomorrow. Dan Halley and I will be speaking with Nvidia CEO Jensen Huang after the earnings call. Stay tuned. We've got more market coverage after this. Let's get to some trending tickers. First up, Target. Shares of the retail giant are sinking after Target missed on earnings. It also issued a forecast for the current quarter well below expectations. Target shares have lost nearly half of their value since touching an all-time high back in November of 2021. They are up this year. Before today, they were up by about 9%, although obviously they have cut that. But the stock is down the most since November 2022 today, after they reported comps fell 3.7%. That is comparable store sales, which was the fourth straight quarter of declines.
Yeah, so the stock taking a big hit. What are bulls saying today, Julie? Well, D.A. Davidson's Mike Baker got a buy ring. Here's what he told his clients. Bottom line, not the best print, he said. You got to acknowledge that, but largely is basically in line. Thinks this is not justifying the kind of sell-off we're seeing for a stock trading at a below-average multiple. In other words, he thinks it's attractively valued here. With comps poised to turn positive, he said, margins are still improving. We think this makes for a buying opportunity. He reiterated his buy rating.
That's interesting. I mean, even Simeon Gutman over at Morgan Stanley, who also is has an overweight rating, he was confused about the increase in SG&A, sales, general administrative costs at the company, and that was a head scratcher for some of the other analysts as well. And then on top of that, you have traffic and average transaction falling 1.9% last quarter, which was really something that analysts said was concerning. They saw a drop in home goods and furniture and apparel and food. So, this current quarter could see an uptick, but we'll have to see if that materializes.
I spoke to Mike Baker over at D.A. Davidson. He kind of made the comparison. He said, he has buys on both, likes Walmart, but he's like, listen, they are best in breed, firing on all cylinders. Okay. Target, turnaround story. You either believe it or you don't. Finally, our next trending ticker, let's check out Lululemon here. Shares falling as much as 7% today following the news that its chief product officer, Sun Cho, is leaving. So that was the news. Chief product officer leaves. It does not sound, Julie, like she's getting replaced, apparently. Right. Her responsibilities, it sounds like, instead of kind of getting shifted to other colleagues. Correct. And I did see some analysts who cover the company quoted as saying, this news just kind of added to these broader worries they had. Maybe this means further sales weakness. In other words, people reading into it.
You know what I'm worried about?
What?
The belt bag. Are you familiar with the Lululemon belt bag?
Do tell.
Okay. It's what we used to call fanny pack. And then it got like a 2020s makeover, and now it's called a belt bag. And you don't always wear it around your waist. Sometimes you wear it around. Okay, I have two Lululemon belt bags. I read in one of these notes today, or one of the commentaries, the belt bag might be going out.
Really? Lululemon's belt bag.
I like my belt bags. Yeah. I don't want to get rid of my belt bags.
The fanny pack has made a big comeback, I gotta tell you.
Exactly.
It's a whole thing.
I might have to switch to my Dagny Dover. I have too many of these things, clearly. But my point, there is a bigger point here. Yeah. It's not just about my own personal, what I'm carrying around my stuff in, but that is Lululemon losing some of that cachet is kind of the bigger question here. Remember we talked to Adrian Yee, who talked of Barclays, who talked about that the wide leg denim trend was hurting Lululemon. Remember that conversation with her, and she said that this was sort of an incrementally negative data point that this executive was leaving.
They do report Q1 results coming up June 5th.
Yes.
So hoping to get a little more insight and guidance that time.
And analysts are looking for the smallest same-store sales growth that we've seen in quite some time for the company. Finally, we're taking a look at some buy now, pay later stocks. Affirm, PayPal, Block, they're all lower today after the Consumer Financial Protection Bureau proposed a new rule that would force the lenders to adhere to the same consumer protections as credit cards. So it was sort of an interpretation of existing rules and laws that would create more parallels between credit card companies and some of these companies. In other words, that they would have to, adhere to some more stringent standards, although a credit card company has to assess a borrower's ability to repay.
Yeah.
They're not suggesting that the BNPL companies will have to do that.
It's interesting because it's not surprising, maybe, Julie, that you see regulators at least kicking the tires more and more because BNPL has grown so. It just as an industry saw this big jump in usage as e-commerce just exploded during the pandemic.
Right.
And now others have jumped in. I mean, how many big banks even offering these, pay over time products? So maybe not too surprised to see, Washington at least taking harder looks.
And Affirm, for its part, said in an email to Yahoo Finance that they've already disclosed that the CFPB already oversees some parts of their business, and they're going to continue to work with them. Yeah. So we'll see how it ends up affecting them. Well, new data on existing home sales for April out today. That number declining for the second straight month to an annual rate of 4.14 million. Yet the median price of an existing home sold rose by 5.7% year over year to just over $400,000. Joining us now, Realtor.com chief economist Danielle Hale. Danielle, it's good to see you. So as we look at these numbers and this continued weakness, can we mostly point the finger at mortgage rates, which have not come down?
Yeah, I think mortgage rates and the resulting lack of affordability in the housing market is a key culprit behind this disappointing print today. I should say somewhat disappointing print. So 3.14 million, or I'm sorry, 4.14 million, a modest decline from last month. Home sales have been at this relatively low 4 million plus level for the past several months. They're really kind of struggling to break out of here because there are some significant challenges in the housing market, not just higher mortgage rates, but also home prices that hit a new high for this time of year and continue to present affordability challenges. In order to really make some headway against these challenges, we're going to need to see more building. The housing market continues to be short on supply, even though we did see some optimistic numbers, some signs of improving supply. We're still not at a point where supply is ample enough to help cool off home price growth.
Danielle, let's stick with mortgage rates for a second, because I'm on Mortgage News Daily here. They're telling me the 30-year fixed, Danielle, 7.09%. I'm interested where you think that is, 6 months from now, Danielle, 12 months from now. And what's the rate that we need to see to really jumpstart greater activity, Danielle? Do you think it's 6.5, 6, lower?
Well, when you look at outstanding mortgage debt, 90% of it right now is under 6%, and about 2/3 of it is under 4%. So for existing homeowners who are, maybe reasonably happy with their home, but ready to make a trade either up or down or to something different, it is really expensive to try to get a mortgage at a 7% rate compared to their current rate. 90% of them are under 6%. And 2/3 are under 4%. So it makes it a lot more expensive to move. The closer we get back to those numbers, I think the more we're going to see housing activity ramp up. And every drop in mortgage rates brings some potential buyers and likely sellers as well back to the housing market. So every little step down is going to help. But I think we're not going to get to levels where we're going to see a jump start in housing activity. I think it's going to be more of a trickle or a slow comeback in housing activity as those mortgage rates come down.
Danielle, I'm really curious about the new home market versus the existing home market, right? The existing home market, much bigger, to be sure, but we are not seeing the same kind of pricing pressure in the new home market. We're seeing incentives still be offered because the home builders want to move those homes. So if people are looking right now, are new homes actually more affordable on a relative basis?
They're not necessarily more affordable on an absolute price basis, but I think new homes are definitely an area that consumers should explore, especially if they're in a region like the South, where builders have been really active. Parts of the Southwest, builders remain active. And so, builders don't have a low existing mortgage rate that they are tied into. And so they have continued to build and create inventory that is available for buyers. They also are, they're a business. And so they're very pragmatic when looking at the market. If they need to make incentives in order to make a home purchase affordable for buyers, they have shown a willingness to do so, whether that's cutting asking prices or offering mortgage rate buy downs, either temporary or longer term. And so as a result, if consumers are shopping and they see, if they haven't considered new homes, it does make sense to consider them. New homes right now, because builders have done a good job of keeping up their pace of activity, represent about 30% of the market of homes for sale. So it is likely that consumers are going to have new homes as an option to consider, and perhaps more so than they can find in the existing home market today.
All right, Danielle, always appreciate having you on the show. Thanks so much for joining us.
Absolutely.
Coming up, we're playing ball in the latest edition of our series, Goodbye or Goodbye. Find out which sports media stock could be a home run for your portfolio. Stay tuned. More market domination after this.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're taking a look at sports media stocks in a matchup between one intellectual property owner and a distributor. What's the best way to play it right now? I'm here with Chris Morangi, co-CIO at Gabelli Funds. Thanks so much for being here.
Great to be here.
Appreciate it. So let's get to your buy stock first, and it is Atlanta Braves. Now, this is an interesting one. You were, interestingly enough, not the first person who has talked to us about this stock, but it is not one that's widely held or that is as much talked about within the sort of media space. The shares are down over the past year about 8.5%. But if you look at it, you talk about the loyalty that people have, right, to something like the Atlanta Braves.
Sure, I know everybody wants to talk about AI today with Nvidia. This is in many ways the anti-AI play. This is in person. This is a 150-year-old company. It's the oldest continuously operating sports franchise in North America, the Atlanta Braves. There are very few opportunities to own sports assets in the public markets. This is one of them.
And as you talk about owning sports in the public markets here, we have seen in the private markets that there's been a lot of growth. So this shows here on this chart the NFL and where we've seen that growth, the NBA, the MLB, the NHL, and the compound annual growth rate altogether is 16%. So in the private markets, we have seen that growth.
Sports assets have appreciated actually greater than the S&P over this time frame. They've been great stores of value for lots of reasons that we'll talk about, but there are, again, very few ways to participate.
Yeah, there aren't very many ways to participate. So what's interesting is that you say that the Atlanta Braves are trading at a discount to that private market value, which is sort of counterintuitive.
Well, so first we start with what the private market value is. First, we calculate the private market value of the team based on where other sports teams have transacted in the market over the last 10 or 20 years.
Okay, and we have a look at that actually.
And these are some of the recent comps in various leagues. The Phillies are the most relevant. They sold a minority stake for 7 times revenue. We value the Braves at something like 5.5 or 6 times revenue. You add the value of the real estate, which they have around the park, and you get to a value of something like $3.5 billion for the company, divided by the 62 million shares, and you get to a stock price in the high 50s versus 40 today.
Okay, gotcha. So that is a considerable discount, and it is illustrative to see, the Phillies valued it at $2.8 billion. And then you have to ask, with seeing those valuations kind of as the result of deals and knowing how much people are willing to pay for them, it has to lead you to ask, could we see a deal with the Braves?
Right, so there's been a persistent discount on other sports assets. This is a little bit different because this asset is controlled by John Malone and the folks at Liberty Media, who split it off just about a year ago in July, in my view, as to position it for sale to a private buyer who can capture that trophy value and close the discount to private market value.
Would we potentially see a sale of part of it, or do you think it's more likely would be the
you'd sell the entirety of the public company.
Gotcha. So we always talk about what a risk could be potentially, and in this way, you say boredom is kind of a risk. In other words, like if you no catalyst, you go kind of muddle along without a deal or something else happening.
I use boredom in particular because a lot of people find baseball boring. It's not. It's gotten more exciting with some of the rule changes. But yeah, listen, there's not a lot of downside in my view to the private market value of this franchise. It's not like it's going to get technologically disintermediated or they're going to fall on their face in terms of earnings. Really, it's just a matter of the discount persisting for a very long period of time because there's not a transaction to surface the value.
Do you happen to be a Braves fan also?
I am not a Braves fan. I am a New York Yankees fan.
I was going to say, your accent implies you would be more a Northern fan than an Atlanta Braves fan. And you guys do own Atlanta Braves in your portfolios.
Our clients are actually the largest shareholders of this company.
Okay, there you go. So let's talk about the stock you don't like. This one is interesting. It's Disney. Now, these shares are up over the past year. There's been a lot going on with Disney, obviously. The first reason you call it analog dollars for digital dimes. What do you mean by that?
So first of all, let me preface this by saying, before I get all the Disney nerds out there mad at me, Disney has fantastic intellectual property and is run by a very great leader in Bob Iger, but it's still not immune to the forces impacting the media industry. And I started as a media analyst 20 years ago, and I'm very familiar with those. And that's basically this concept that media companies were over-earning for decades in the old big pay TV bundle system. That has come apart with streaming, and it means that the companies are going to earn less going forward. And Disney's done a pretty good job of transitioning their business to direct to consumer, but it's never going to be as good as it once was, and still has some challenges in the immediate term.
And when you also say analog dollars for digital dimes, is that they do have an analog business also in the form of the parks. but they're also investing all this money in trying to make streaming sort of work.
Yeah, and the parks business is more than half of the EBITDA, more than half of the cash flow of this company, and more than half of the value too. And we still like that business on a secular basis. The experiential economy is one we've been a proponent of. It actually it works for the Braves as well. But that one actually has some cyclical challenges coming up.
Well, yeah, and let's talk about that, the economic sensitivity. Those parks are not getting any less expensive.
That is for sure, for those of us with children who've been there recently.
Yes.
And both Comcast, which owns the Universal parks, and Disney have called out a moderating demand this summer in their parks, just as we get through COVID normalization, and frankly, as the consumer is a little bit strained and can't spend as much.
And then we showed that stock chart at the beginning where the stock has appreciated something like 18.5% over the past year. And as I said, there's a lot that's been going on, namely a big proxy fight, right, that has helped in part drive the shares up. What now?
Yeah, exactly. And that's sort of the issue, is that a lot of the catalysts are in the rearview mirror, whether it's the Tri-End proxy battle that you referenced, taking costs out, getting the DTC business, the direct-to-consumer business, to profit-neutral profitability, which they've all done, and check those boxes, and that's why the stock has done well. From here, it's going to be more difficult. It's trading at call it a 20 times kind of multiple, maybe a slight premium to the market, and there's just not enough of a margin of safety for us to continue owning it.
Okay, so let's talk about what then could go right that would maybe change your view. They do have good assets. They do still have Bob Iger in there. We don't know what's happening after Bob Iger, but he could turn the ship.
From here, it's largely an execution story, and if they over-execute, if they take more costs out, if they get direct-to-consumer right faster than we think they will, the stock is going to continue to do well. The other thing I'd mention is this is an industry that's undergoing consolidation. You've got Paramount, the subject of a takeover battle. Warner Brothers Discovery could be another one. I don't think it's likely that anybody buys Disney, but there have been whispers of Apple, for example, being interested. Again, I don't think that's likely, but it's not a non-zero chance, and that is a risk to the upside.
Now, you said you wouldn't want to own Disney, or do you guys have some Disney?
We've owned Disney in the past. We've been saying goodbye to it.
Interesting. Okay. But you still have a little bit, but you're working it down.
And we're very tax sensitive, so we have clients with very low basis, for example.
Understood. Chris, thank you so much. Let's summarize what you're telling folks here. You say you would buy Atlanta Braves holdings based on its significant discount to sport teams' private market value. On the other side, you think avoid Disney amid the decline of traditional media and lack of catalysts going forward. Chris Morangi, good to see you. Thanks for coming in. And thank you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes 3 times a week at 3:30 p.m. Eastern.
Time for some calls of the day. Goldman Sachs upgrading Shopify today to buy it from neutral and raising its price target to $74, up from $67. So, this stock is interesting. It's been under some pressure. It's down more than 20% so far this year. Goldman says, though, okay, that is an opportunity, because they say, yes, there's an investment cycle weighing on margins, more mixed consumer spending. We know that's been weighing on the stock, but they tell their clients, you stick with this one because Shopify has significant technology moat in e-commerce software, share gain across e-commerce cycles, they point out. Bottom line, that's going to drive, Goldman says, durable growth at scale. Goldman does point out some risks, but bottom line, they say this one's a buy to their clients.
Yeah, and the stock is down like 25% year to date. So they're looking at it and seeing all of that is perhaps priced in and not justified given that. And they talk about the company has been investing in what they call large adjacencies. In other words, sort of bolt-on technology, things that are adjacent to their business that will be accretive over time. And that's also one of the reasons that they like the stock. Yeah, there are some downside risks they point out. Listen, they say consumer spending could be worse. That would pressure GMV. Shares in e-commerce could be impacted, they said, by kind of aggressive investment from companies' rivals. That's Amazon, Temu, but that is not their base case here. They're buyers. And then we got Hims & Hers to talk about. Also, Hims & Hers being downgraded over at Citigroup to neutral from buy, but the analysts are also raising their price target from $16 to $20. The stock is down 7%. I have to say, this is one of the more effusive downgrades that I have seen here because the analysts there still like Hims & Hers over the long term. They talk about the recent announcement that the company is going to be selling GLP-1s through their site, and they say assuming an average selling price of $230 a month, this equates to an almost comically large $30 billion revenue opportunity. I love that, but the stock has rallied a lot, so that's basically why they're saying they would take a pause here. That's it. After that announcement,
announcement, they say, listen, the stock jumped 20%, added about $760 million of enterprise value, leaves little room for upside in their opinion. They say, given the significant uncertainties around the economics and durability of GLP-1s, we're moving to the sidelines.
Indeed, and so are other investors today to some extent. Well, coming up, we're breaking down the best ways to position in your portfolio in the software space after some key announcements in the sector in recent weeks. Stay tuned for the Yahoo Finance Playbook on the other side. Microsoft is going all in on AI. The company this week announced a new category of PCs called Copilot Plus. Their computers equipped with so-called AI PC chips and will now run on OpenAI's GPT-4o model. So as software technology continues to advance, we're looking at how to navigate the big picture and the best ways to position your portfolio with the Yahoo Finance Playbook. Let's welcome in Rishi Jaluria, RBC Capital Markets software equity analyst, as well as Frederick Havemeyer, the head of U.S. AI and software research at Macquarie. Gentlemen, thank you so much for being here. I guess let's start, first of all, with the Microsoft announcement itself and sort of how we should think about it as investors, how big of a deal it will be, how incrementally it will add to revenue, et cetera. Rishi, I'll start with you.
Yeah, absolutely. And thanks so much for having us. We were just out in Seattle at Microsoft Build this week. And look, I think the introduction of these AI PCs is actually going to be a really big game changer to getting generative AI in the hands of every knowledge worker out there, right? Recall, when you use any sort of GPT system today, it requires a fast internet connection, a lot of computing power. Now, it's gonna take time till they get light enough that everyone can use them. But you'll be able to use some of these more small language and medium language models locally without a super fast internet connection. And so that I think will enable a lot more kind of general purpose AI use cases and workloads that previously didn't exist. So I do think this is a very exciting announcement for Microsoft.
Fred, let's bring you in here as well. Same question, Fred. So, your reaction to that Microsoft event. Rishi says these new AI PCs, game changer. Fred, do you agree?
So for the past year, we've been making the call consistently that AI is going to have to move to the edge. It's going to have to move to the device. And in many cases, this does require hardware like what Microsoft is rolling out to do it. And it's what would get us excited, both about making this accessible to consumers and knowledge workers, plus also being able to drive uptake of AI in a profitable way. Because if you recall, I think one of the last times I was on Yahoo Finance, we had a great time talking about what smaller language models mean, large language models, still quite large, but nevertheless smaller, mean to margins. And as we found and we explored in the past, we think that achieving 80% to 90% plus gross margins with running generative AI models can be done by using small language models on specialized hardware or on local devices. So I think quite exciting.
Fred, just to follow up on that, you wrote in a recent note about how consumers are going to determine the impact here. And I keep trying to figure out if where we are in the AI cycle is still push or if it's starting to be pull. In other words, like all this stuff is coming out, are customers, particularly on the retail side, asking for this? Or are these companies still at the phase where they have to convince them that they want it?
I think that when we look at products out there like ChatGPT, I think we already see that there are north of 100 million users that I would qualify in many cases as consumers really interested in these types of products. Now, commercializing it and making it something that's useful and interesting for consumers, I do think that there are technologies out there that have been perhaps what you could describe as a solution in search of a problem. And at the same time, I do think that it's very clear to us that the technology of a generative AI model, of large language models, is something that will find fit with consumers over time. ChatGPT did, and I think that with the right interface and the right platform, we'll find it over time. I mean, I'm a user of Meta's Ray-Ban glasses. Not here to discuss Meta, but just the glasses. They're fascinating. They're really good, and I really enjoy having this like modality of working with these generative AI models sitting right in my glasses. So we'll see over time.
Rishi, same question. I mean, when you look across your coverage universe, Rishi, what kind of customer adoption and engagement are you seeing when it comes to these new AI products and features?
Yeah, absolutely. And I'm glad you have me alongside Fred, because I definitely agree with him on a lot of what he's saying. Look, what I would say is when we're talking to companies, we're talking to CIOs, CTOs, heads of IT, there is real appetite for AI usage within the enterprise. A lot of this, I would say maybe 70% of it is actually net new budget. So it's not even cannibalizing other parts of IT. It's coming out from other parts of the organization. So there's real money being earmarked. We're seeing, I'd say 80% of CIOs are telling us that they are either currently in production or expect to be in production with AI over the next 12 months. So the appetite is real. The use cases are real. And remember, we're still at very, very early stages of this. If I draw the analogy to the internet stages, even though GPT-4o is incredibly powerful, this is probably 14.4 dial-up level, right? We haven't even reached high-speed broadband. So I think there's still a lot more way for the technology to advance from here, but already seeing real interest from the enterprise and from consumers as well.
So we know you guys both like Microsoft. Even before this latest event, you guys both have outperform ratings on that one. Fred, with you, I want to dig into a couple others because you like a couple of the cybersecurity names, including CrowdStrike. We recently heard from Palo Alto. That seemed to make investors a little uncomfortable here. Do you think the likes of a CrowdStrike are going to benefit from AI as to how it relates to cybersecurity, or is it just a more general cybersecurity play?
So we do think that it relates, like CrowdStrike is really benefiting, I think, from generative AI as a trend. While they're not selling generative AI themselves, we think that the advent of generative AI is making it much easier for attackers to exploit a lot of things like, for example, phishing attacks are becoming far more sophisticated. Attackers that want to build software are getting also just power-ups now, being able to use generative AI perhaps to actually build malware more effectively. We think that CrowdStrike, which protects the endpoint, it protects the device as the last line of defense against all of those attacks that have penetrated every other layer of security, is really well positioned to defend against the brand new unknown threats that we think are likely to emerge with the advent of generative AI. So really like CrowdStrike is our top pick for just overall trend-based exposure to generative AI in the cybersecurity sector.
Rishi, one name I'm interested in. So you got outperforms on Microsoft, CRM, so fan of Nadella and Benioff. You also, Rishi, like Zoom, which has been a tough slog. You know, in the red, Rishi, year to date over the past 12 months. Why is Zoom a buy here?
Yeah, I think Zoom has a really interesting play when it comes to AI. There is so much unstructured data when you think about video and audio, even nonverbal communication, that I think Zoom has a really interesting roadmap. I think the hiring of IXIC from Microsoft was a great one, and I really like the kind of thought leadership Zoom has put out on having a federated AI approach. You think about things like sales coaching, that it can tell salespeople, look, you're not making eye contact, stop wandering and make eye contact with your prospective customer. HR, when you're doing interviews with people, hey, this body language suggests that the prospective employee might be wrong or lying, maybe prod them with one or two follow-up questions. And I think about those use cases, maybe even verticalizing them for the contact center, where contact center Zoom has been getting a great amount of success. I think Zoom is very much an underappreciated AI play in my book. And
I love that it will help you be more human or interact better with other humans. That's just sort of a fascinating offshoot of all of this. You got one other one you guys both like is Salesforce. And Rishi, I'll take you quickly on this, and then we'll get Fred's opinion on why you think it is going to benefit here. I mean, that stock has also had some exogenous things going on, activist pressure, et cetera.
Yeah, I will say my bullishness on Salesforce is more related to the self-help element of the story. I think there's a lot of margin expansion from here. There's a lot more cost cutting they can do, a lot more efficiencies they can bring to the organization. So the stock feels very much undervalued in my book, and I think there's upside to numbers and upside to the multiple. From an AI perspective, I will say maybe I'm a little counter consensus on this. I want to see more out of Salesforce when it comes to AI. In theory, they could be a huge beneficiary. They're a system of record. Salespeople, marketing people all rely on it day in, day out, and it's a huge platform with this massive ecosystem. But I just haven't seen enough innovation out of their AI roadmap, where I would contrast that with HubSpot, which is another name that we really like, that has been showing a lot of innovation on the CRM front. So I think Salesforce has its work cut out on the AI front.
All right, Fred, quickly want to get your take.
Yeah, I think that I'm quite aligned here, actually, with how Rishi is approaching this. I think in the big picture of the software space, Microsoft, of course, we talked about, fantastic. I think ServiceNow stands out to me as one of the top generative AI picks in our portfolio. Salesforce, I really like. I do think that you have an opportunity here to just thoroughly imbue generative AI and AI throughout the entire Salesforce stack and make sellers, customer service agents, and the like much more powerful. I do want to see them delivering more functionality, which I think they're able to. And in the meantime, I do think that this overall margin expansion story with stable, profitable growth is something that keeps the stock quite attractive and keeps us bullish on the name.
Fred, Rishi, great having both you guys on the show today. Thanks for joining us.
Thank you.
We're wrapping up today's market domination. Don't go anywhere. We've got you covered with all the action following the closing bell, and it's all about what else? Nvidia.
There's the closing bell on Wall Street, and now it is market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today's session. So let's start with where the major averages ended up near the lows of the session for the Dow Jones Industrial Average. And as we talked about earlier, that's after we got the Federal Reserve minutes from the last meeting, which indicated participants' willingness to perhaps tighten policy if inflation data does not improve here. So we saw that pullback in the Dow of about 0.5% or 200 points. The S&P down about 0.25%. The Nasdaq down 1%. And then the Russell 2000 really taking a bigger hit here. It tends to be more interest rate sensitive, and that was down about 0.9%. All of that as we saw a relatively modest move in yields upward on the 10-year, only 2 basis points higher to 4.43%. And then, of course, there's the other story that we continue to watch for, and that is Nvidia. Nvidia off about 0.5% on the day. Remember, it closed at a record yesterday, but pulling back a little bit into its earnings that are coming in just a little while here. As we talked about it earlier, the share's up some 92% year to date. Let's look at a 3-year chart just for fun, up 530%, Jared.
Not only that, we've had some records recently, but not today. So let's get to our sector action, where tech was just barely holding on to some gains here. And there we go. XLK up 23 basis points for the day. Healthcare, industrials, communication services also rounding out some of the leaders here, but not by a lot. Energy took a hit to the downside, 1.85%. XLU, that's utilities, taking a downbeat, and discretionary also down about 1%. And let's check out our leaders here. We have solar energy. First Solar is a kind of the story there, but TAN, the ETF, is up 9%. Then we have the SOX ETF, that's chip makers, up 1%, despite the Nvidia loss today. Biotech also in the green, but what didn't work, oil was the worst sector. PSCE covers small oil drillers. That's down the most here, down 2%. Home builders, cannabis, and bets, that is gambling, rounding out the bottom row there. And let's take a look at some heat maps here. We got ARC, Tesla down 3.5% today. So innovation, the disruption field, kind of mixed. We do have CRISPR Therapeutics up about 3%. So is Shopify and Coinbase just behind them. And let's take a look at China, which had a bit of a setback today, but Pinduoduo after earnings up 1%. And those were earlier in this week. Guys?
Jared, thank you. Stocks closing the day lower as markets continue to await the latest earnings report from Nvidia. Joining us now for what the report could mean for investors and the broader markets, let's welcome in Art Hogan, Chief Market Strategist at B. Riley Wealth. Art, it is good to see you. So let's just start right there. Or Nvidia after the bell. What do you expect to see, Art, and what does it mean? You know, the company reporting, what CEO Jensen Huang says. What does it mean for the broader market?
Yeah, it's interesting, Josh. This is a company that's actually surprised Wall Street for the last 4 quarterly reports. 3 of those quarters, they had a massive updraft after the reports because they beat by so much. So the average over the last 4 quarters on the earnings line, the consensus was beat by about 20%. They likely won't beat by that much in this particular quarter. And they've grown their revenues 200% over the last 2 quarters. So clearly that's a tough bar to cross. That said, we know they're sold out, right? We know this is a company that can't make these things fast enough. But we also know the introduction of the Osborne effect, meaning they've got a new product coming out in the fall. Does that delay orders or push off orders of the H200? We'll have to see how they navigate that process. I think all in, this is a company that's in the early stages of what's going to be a massive TAM, and I think that if there's a negative reaction to anything they have to say, it's likely a buying opportunity. Very much like last quarter when they beat the numbers broadly but had run up into the report. Stock pulled back, and 2 weeks later, that was a screaming buy. So I think you may see that same kind of effect where you have a mild disappointment, whether it's in the revenue line because people are maybe waiting for the next chip. I'm not predicting that, but it's certainly a possibility.
Hey, Art, it's Julie here. So as we've been talking about all day, Nvidia is important, of course, not just for itself, but because of its weighting. And we're actually looking at its weighting in various averages right now, more than 5% of the S&P 500. But it's not just that. It's also the sort of companies or its customers and its vendors and utilities too, and whatever else has to do with AI. So how are you thinking about playing it on a sort of broader basis?
Yeah, well, I think, Julie, that's a great question. I think 2024 has proven to be the year where we shifted from everyone has to say AI and declare that they've got an artificial intelligence plan. where in 2024, we're really not willing to have people spend too much on AI necessarily and not tell us where the revenues are coming from. So really it's the two of the hyperscalers that have done very well and have shown us how they're going to make revenue with this, this new technology, which is artificial intelligence, whereas Meta came out and said, we're spending this much, but we'll tell you about the revenues later. I think that's the new dynamic right now, and I think that's really important. But to the extent that you look at an Nvidia, which I think is important because it's really the first and only company that can show massive revenue growth in this new dynamic that is artificial intelligence, I think it's important to understand that they still trade at a relatively reasonable multiple unto themselves on a forward basis. They're trading at something like 38 times. That will surely come down after they report. On a trailing basis, trading about 78 times. That likely comes down as well. That has happened 4 quarters in a row. But I think in a real sense, there's not many surprises necessarily because we've already heard from most of the big customers and they've already told us how much we're spending on artificial intelligence, and a great deal of that funnels down to Nvidia. So I just think that it's Nvidia's game to lose here, and they've done a very, very good job of managing that process throughout the last 4 quarterly reports. I suspect they do a great job this time.
And beyond Nvidia, Art, when you look across for opportunity in the stock market right now, broadly, do you still want to be overweight tech here?
Yeah, I think you do. I think it's for example, a great example of that would be Apple, who, of the Mag 7, the last company to really talk about what their artificial intelligence program will look like and what it's going to mean to the user. Worldwide Developers Congress happening in June likely is where they roll out and make that final announcement. Everybody jumped on the bandwagon early and said, yes, we're using AI. Here's how we're going to use it. We're going to make you more productive. You're going to love the experience. Apple has waited. Apple's a fast follower. They're never first in anything. They weren't the first MP3 player or laptop or notebook or phone. And I think this is going to be another example of that. So when you think about big tech that hasn't appreciated their potential in artificial intelligence, Apple likely falls into that category, and you only have to wait to June to find out what that means to you.
All right, so let's get beyond tech for just a second here, Art, because we got those Fed minutes today as well. That put a little bit of pressure on the market. At this point, do you think there's a chance there could still be a hike in rates?
I don't think there's a chance there's going to be a hike in rates this year. I think that we've seen the trajectory of inflation starting to slowly work in the right direction, right? We had a hot CPI that caused a sell-off in April, a cooler CPI. We had a hot jobs number that caused a sell-off in April, and also made Treasury yields bounce pretty high from 4.3 to 4.7%. Both of those have receded, and you're seeing a cooler jobs print, and you're seeing a cooler CPI. That likely continues, especially since for the first time in this whole cycle of 16 months, owner's equivalent rent, the portion of shelter costs, has finally cracked a little bit. And we know in reality that likely cracks a whole lot more. So I think by the time the September meeting rolls around and the core PCE is sitting at 2.7%, where they had projected it might exit this year at 2.6% and penciled in 3 rate cuts, will likely make them feel comfortable enough to throw the first rate cut at us. But I don't think rate hikes, I really don't think is part of the program right now.
Art, really good to see you. Thanks for being here.
Thank you.
Well, we've got some earnings today from Synopsys, not Nvidia yet, Synopsys, that software company. Those shares are down by 4%, and that's after Synopsys actually cut its forecast for the full year here. So that seems to be weighing on the shares. This says the company also announced it got shareholder approval for its acquisition of Ansys, which it announced a couple of months ago. So if you look at those Synopsys numbers for the full year, it's now expecting $6.09 billion to $6.15 billion in revenue. 6.57 to 6.63 is what was estimated there. So cutting it close to what analysts had been expecting, actually. And the company also, for its second quarter, its earnings per share did beat estimates at $3, and revenue did rise 4.3%, roughly in line with estimates at $1.45 billion. But this is one of these companies, when we talk about these ecosystems around AI and around, this is one of those companies that not that much of its business is AI yet, but it's in the semiconductor sort of ecosystem.
Yeah, they provide software to help engineers design, architect, verify chips. AI, it was interesting though, Julie, before this print, you saw some analysts, I think at Bloomberg, for example, arguing it is one of those names where AI should be a long-term tailwind because the AI solution, these analysts were arguing, is gaining traction with customers. Another issue, Nvidia, I don't know, have you heard that we're mentioning that a bit that name?
No,
this show?
who?
Yeah, right, NVIDIA. Remember, Synopsys recently told us they're actually now working with NVIDIA not too long ago, basically helping NVIDIA develop chips faster, essentially. So it'll be interesting how much that's talked about in the call as well.
Yeah, and Sassine Ghazi in the statement talking about customers continue to invest in Synopsys to maximize their R&D and power future innovation. So, the shares are down, but he's sort of striking an optimistic tone. And we're going to get more from Sassine, by the way, because we are going to be speaking to him tomorrow. Synopsys CEO Sassine Ghazi will be joining us on the program. There's another company out with earnings that is far from AI. We're talking about underwear and clothing, VF Corporation, and shoes and sneakers.
They might mention AI. You don't know.
No, they certainly could. Maybe you can try. Maybe you can try and close with AI. I don't know. VF Corp reporting fourth quarter earnings. The Vans owner coming out with those numbers. And speaking of which, Vans expected to be weak here. But if you look at the numbers, the company, adjusted loss per share from continuing operations, an unexpected loss there of 32 cents. Adjusted earnings per share of 1.3 cents is what analysts had been anticipating. So an unexpected loss there on an operating business basis. And the company also saying 2025 revenue will rise by 10%. This is after its fourth quarter revenue did miss analyst estimates. They're naming a new CFO as well, Paul Vogel. So that's amongst the announcements we're getting there from VF Corp.
Yeah, it's a company that controls Vans, North Face, Dickies, and they did hire the new CEO over the summer. And there's been kind of these concerns. I mean, the stock's been under a lot of pressure, and heading into the print, even a lot of concerns about weakness in North America wholesale, direct to consumer, and the street, even with that stock being hit, not much love. You think sometimes street starts to think things are priced in, but most still on the sidelines.
Yeah, just quickly here, I'm looking at the division breakdown. Vans revenue in the fourth quarter down 26%. North Face revenue down by 5%.
Wow. All right. Moving on, time now for what to watch Thursday, May 23rd. Starting off on the earnings front, see a batch of retailers reporting, including Ross, Deckers, and Ralph Lauren. Ross announcing first quarter results after the close. Analysts expecting the company to increase Q1 sales as Ross expands its reach to better brands, including Nike and Michael Kors.
Moving over to the Fed, we'll be getting some commentary from Atlanta Federal Reserve President Raphael Bostic in the afternoon. This coming after the FOMC minutes from its May meeting were released earlier today, where various members mentioned willingness to tighten policy further.
And take a look at the economy. Another piece of economic data coming out in the morning. That's the monthly Purchasing Managers Index report for May. Economists forecasting an uptick in services while manufacturing holds steady, giving us another piece of the economic puzzle as the Fed decides on potential rate cuts this year.
I have to say, we're very excited about our next item, which has to do with NVIDIA. Yahoo Finance is going to have an exclusive interview with NVIDIA CEO Jensen Huang. That will be on our website later tonight, as well as our morning show tomorrow at 9 a.m. Eastern.
And coming up, we're just minutes away now from NVIDIA's highly anticipated first quarter earnings report. We'll be breaking down the numbers when they come out. Stay tuned. More market domination overtime coming up. Bitcoin and Ethereum trending higher this week. Jared Blickery standing by with a deeper look at the latest moves in crypto. Jared.
That's right. It's been kind of quiet over the last 24 hours. On our crypto heat map behind me, we'll pull that up. You can see Bitcoin up 42 basis points, Ethereum in the upper right up 33 basis points. Let me just show you the trailing 5 days. We saw an incredible explosion in Ether. This is over the last 3 days. It was Monday afternoon. Word came that those Ethereum, the spot Ether Bitcoin, the spot Ether ETFs finally coming to market potentially, and this would mark an about face for the SEC. And this all came after this FIT21 bill flew through the House of Representatives. Looks like it might get to President Biden's desk. Looks like he might sign it now. He'd come out against it. But all this controversy has just kind of cemented the fact that the parties, two of them, Republicans and Democrats alike, cannot ignore crypto. So crypto is on the agenda, and we'll have to see how that plays throughout the election. But you got to think that there's going to be some favorable talk. But that's just speculation. Let's take a look at Bitcoin prices. If we show the year to date, we can see that Bitcoin is now right up against the upper end of its most recent trading range. Hasn't made any new highs since March, but this looks like a healthy consolidation. We'll have to see if we can gather any steam on the next potential catalyst. I do want to check out what's been and show what's been happening with the ETFs as well. We have a plethora of spot Bitcoin ETFs and also some futures-based ETFs, including Ethereum. And here's the performance today. I just note that we have seen an incredible explosion into some of these individual names. IBIT, that's a BlackRock offering, and Fidelity as well. Guys?
Thanks a lot, Jared. Appreciate it. Well, Bitcoin and Ethereum are rallying this week, as we've just heard, as lawmakers vote on new crypto legislation. Yahoo Finance's Jennifer Schonberger is here with more details. Hi, Jen.
Good afternoon, Julie. It's great to see you. In a watershed moment for the crypto industry, the House is set to vote shortly for the first time on legislation that would create a comprehensive regulatory framework for digital assets. The legislation, being called the Financial Innovation and Technology for the 21st Century Act, or FIT21 for short, is one that House Financial Services Chair Patrick McHenry has been pushing for the better part of a year, and one that the crypto industry highly favors. The legislation would establish the Commodities Futures Trading Commission as a leading regulator of digital assets. There would be clear divisions for what the CFTC will regulate and what would fall under the purview of the SEC. It would also establish consumer protections and bar the sort of commingling of customer funds that played a role in the undoing of crypto exchange FTX back in 2022. Republican lawmakers see this legislation as creating much more clarity for the crypto industry, but most Democrats, led by House Financial Services Committee ranking member Maxine Waters, oppose this bill. Waters warns the bill would effectively deregulate most crypto by removing them from the purview of the SEC. Now, in a rare rebuke, SEC Chair Gary Gensler, who has leveled numerous enforcement actions against the crypto industry, slammed this legislation in a statement earlier today, saying, quote, "It would create new regulatory gaps and undermine decades of precedent regarding the oversight of investment contracts, putting investors and capital markets at immeasurable risk." Now, this vote on FIT21 is expected around 5 p.m. here in Washington. This legislation is expected to pass in the House thanks to support from Republicans and a handful of Democrats. But support in the Senate remains dim at this point. McHenry told reporters late yesterday afternoon he's hopeful that a strong vote tally in the House could galvanize the Senate to take a fresh look at this legislation.
Jennifer Schonberger, thank you very much. Well, we're just moments away from those Nvidia numbers here. Speaking of things that happen at 5 p.m., the conference call for Nvidia. The shares little changed in after-hours trading as we await those numbers that are scheduled to drop at any point here. It looks like we're getting them here. So the company coming out with first quarter revenue of $26 billion. That's versus the estimate of $24.69 billion. Data center revenue at $22.6 billion. That is above estimates as well. Automotive revenue, $329 million. That's been a less important part of their business on a relative basis, but still growing. It beats estimates. And adjusted gross margin at 78.9% versus the 77%. Company is announcing a cash dividend. They raised 150% to 1 cent a share, and is also announcing a 10-for-1 forward stock split. That will be effective on June 7th. The company saying it's poised for its next wave of growth, and we're getting a forecast. Everything's coming at once here, Josh. Second quarter revenue will be $28 billion, plus or minus 2%. The estimate was for $26.8 billion. So, beating on every metric. Once again, announcing this 10
initial reaction.
Announcing this 10-for-1 forward stock split.
Bringing a lot more people in potentially.
I mean, the cash dividend here is small. It's sort of token, but nonetheless raising that cash dividend as well. So, just coming out beating again. But as our Josh Schaefer pointed out earlier, there's not always, what the company says and what the stock does do not always match. This is the first blush reaction, yes, but that could change. That could change after we get the conference call. That could change as investors rejigger. There's a lot of options activity in the stock, as we've talked about. So we will see what ends up happening.
You talk so much about NVIDIA because, listen, Julie, AI is the big trend. Companies are excited. Investors are excited. It doesn't happen without this company, NVIDIA. I mean, how many companies that we talk about, Microsoft, Dell, ServiceNow, they're all building on Jensen Huang's chips. I want to just point out data center. That is, of course, where you make a beeline to $22.6 billion. The estimate was $21.1 billion. A nice big beat there. There was these threads we were pulling on, Julie. We talked about this for analysts. Well, the new GPU platform, Blackwell's coming, and does that mean some of these customers, who knows, they would pause, delay, because they would want to wait for the shiny new thing. But listen, data center beats handily, and guidance also.
Okay, let's talk about gaming for just 1 second here.
Because
I know you were looking for that.
Yes.
Gaming revenue, $2.6 billion, which is a little bit shy of estimates. Now, as we talked about earlier, we showed the pie chart from 2021 versus 2024 and how much more of their revenue now comes from data center. But gaming is not nothing. A $2.6 billion quarterly revenue business is not nothing. And so that's just something to keep an eye on. It has not been as strong as of late. As we've seen a lot of attention and resources shift to.
Well, it is. You listen. We've been covering this company, both of us, for a long time, and the transformation of the company is remarkable.
Yes.
I mean, that's what we used to talk about was gaming and crypto. That's what mattered. And now, listen, gaming is still meaningful. It's an important part of the company's business, but the attention has shifted to data center.
It has, and on that basis, they beat.
They beat. All right, NVIDIA just reporting a beat on earnings, revenue, raising its dividend, and a stock split. And joining us now is Defiance ETF's CEO and CIO, Sylvia Jablonski. Sylvia, it is great to have you. Listen, so you went into this print. Stock was up 90% already this year. The expectations were sky high, but they beat. Sylvia, at least initially here. Investors like what they see. Let's get your initial reaction. What do you make of the report, Sylvia?
Yeah, hi Josh. I mean, this is Goldilocks, right? I think that they beat on both numbers. They beat on profits. They beat on revenues. They're up 200% over the year. Stellar performance. Look, I think AI is the biggest mega trend that we have, and it's going to impact every single industry out there. And these numbers tell us that that's playing out, right? All of these different industries are very likely, increasing the breadth of demand from just tech companies to just revolutionizing, how we do other things, whether healthcare, financial security, financial reporting, banks, risk trading, quantum computing, supercomputing, all of it. So Goldilocks number, Jensen Huang is the man of the year, I think, the bellwether of the market. And I think investors are happy about it. I mean, this move post-market is just great. And the thing that I'd be worried about, and Julie mentioned this a lot of times, the stock price moves around after earnings and then, you don't know where it's going to land. But oftentimes that has to do with data center and outlook. And I mean, 22 versus 21, and then outlook's beating 2. So I think we're pretty good here. Plus the split is awesome, right? It lets investors that had FOMO get in at lower prices.
Yeah, I was going to ask you about this split, Sylvia. How much do you think that, I mean, particularly for, I wonder, and maybe you have some insight into this, that feels like more of a move for retail investors, right, to get in on this. Is there any importance also for institutional investors?
So it's really interesting because just, my lifelong career in capital markets, the response is always that reverse splits and forward splits don't matter. You have the same thing at the end of the day in terms of the notional value. The amount of money you have is the same, right? It just kind of switches for more shares at a lower price. But I think, 100% it's geared towards retail investors, young investors, individuals can now get into this stock. It's really hard to buy a stock that's trading at these prices. And I think that, it's in the case of Nvidia, it is going to matter because I think it's going to open up, new demand, and it's a popularity trade. It's a popular stock. And I think it's going to matter for them. I do. And the cash dividend's nice too. That's going to matter for institutions.
Hey, no one sleeps on capital return. Sylvia, let me ask you this too. I'm just curious. What do you think this report means, Sylvia, for the broader market? What Nvidia reports, CEO Jensen Huang, Julie's going to be talking to him shortly, along with her own Dan Howley. What are some of the ripple effects you see for the market?
Yeah, I can't wait for that interview. Actually, I'm super excited. He's got to be feeling good about this this report. That'll be a good one. But I think that this is going to drive the Nasdaq up tomorrow. I think in the near term we're going to get some continued momentum off of these Nvidia earnings. It's going to be good for the Mag 7, good for the breadth of the Nasdaq, and in general. A couple like in 2022 when all the tech stocks were crashing and Apple did well, that was kind of the tide that lifted all boats, right? And last year, and it's been Tesla throughout time, and this is just the year for Nvidia. Nvidia does well. People feel good about the market this year, and we'll see what happens next year. But this is that trade this year. So short term, we get some positive momentum off of this, I think.
It's funny because it was a trade last year too, Sylvia.
Yeah, I guess it was a trade last year too. But I think the hype, it's like the day that they announced the ChatGPT thing in fall of last year is when this thing really started to go parabolic, I think.
Yeah, we got to leave it there, Sylvia. Thank you so much for that instant reaction. Really appreciate it. Well, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
Our new show, Asking for a Trend. I've got you covered for the next half hour. Dive into all the trending stories following NVIDIA's latest earnings report. Stay tuned. Asking for a Trend coming up on the other side. Hello and welcome to Yahoo Finance's brand new show, Asking for a Trend. I'm Josh Lipton, live from our NYC headquarters. Today, the market, it's all about Nvidia. It's one of the most consequential names in the AI space and largest companies on the S&P 500. The chipmaker just reporting its first quarter results. Let's recap the numbers here. The chip giant beat really across the top and bottom lines in the fiscal first quarter. Revenue soared to $26.04 billion during the quarter against estimates of $24.69, and adjusted earnings per share, they clocked in at 6.12. Second quarter forecast also topping the street's estimates. Nvidia also announcing a 10-for-1 forward stock split and boosting its dividend by 150%. Nvidia has been all the market can talk about. The company has added more than $1 trillion to its valuation this year, thanks to its soaring stock price. It's now the third largest U.S. company by market cap, topping $2.3 trillion. Its ascent has been staggering and fueled expectations that some say have become maybe too aggressive here. Joining me now is his thoughts is Lou Bassanese, MDB Capital President and Chief Market Strategist. Lou, always good to see you.
Yeah, great to be here again.
So let's just start. Nvidia reports this thing, Lou, we were talking off camera. So it's up 90% year to date, right? And really everyone's on the same side of the boat. 90% of analysts were telling me I needed to buy it. It's tacking on another 2.6% in the after hours. What do you make of the report? Give me your response.
I'm on that 10% of the side. I'm a forever contrarian, and valuations always kept me out of this. But if I look at this report, I mean, cue up the Wayne's World. It's party on mode, Garth. I mean, let's go, because there's nothing bad in this report. I think the risk, if I had to find something, was the magnitude that they beat earnings expectation is the smallest it's ever been, about 8%. If you look back a year ago when they reported that first blowout quarter that kicked off the AI hype machine, it was about a 40% beat. So I think expectations at some point are going to get too far ahead of what Nvidia can deliver, but it's not yet. So
you're not in because of valuation concerns. And listen, that when you had skeptics on the show, they would bring that up. Yeah. Is there a level, Lou, you're more comfortable with?
Look, I think if I had to be rational, right, the valuation used to be completely out of whack until the company's grown into it. It's now at like 40 times forward earnings. If you look at Microsoft, Apple, maybe in the low 30s, I think that makes sense for a multi-trillion-dollar market cap company. Because you got to remember, right, there's an opportunity cost. How far can this market cap go? I mean, Apple hit $3 trillion last year. That's the peak, right?
It's already $2 trillion.
Right.
You think you move into does it join Microsoft in the $3 trillion club?
I mean, it could be. I think it's the leading candidate to be the next $3 trillion market cap company. But if I had $1 to put to work today and I want a 10x it, it's not in Nvidia, right? It's probably in the smaller cap side of the market, or you be more conservative. If you want to look at the Mag 7, I mean, it's really Alphabet is the most reasonably valued on a forward basis.
Can I get besides the bottom and top, the stock split news? What's your take there?
I think it's a brilliant move psychologically, because if you look at the data now, about 40% of trading volumes is retail investors now in the latest couple months. So this is a great way to psychologically bring in more retail. I mean, it doesn't change any of the fundamental metrics and valuation calculations. But if I'm sitting there thinking about buying 100 shares or a share, it's a lot easier and more palatable at $100 versus $1,000.
What do you think also, I'm just interested to get your take, not just what this report means for Nvidia, for Jensen Huang, what are the ripple effects, broader market implications?
It's huge. I mean, I think, as tech goes, so goes the market. I mean, 40% of the S&P 500's gains have been attributed to the tech sector, if not more. If you're looking back historically, it's similar to the dot-com days. So we needed this, right? I mean, this is the leader of the AI trend, but we should have expected it too. If you looked, you reported on Microsoft's results, Amazon's, Google's, we saw the acceleration in cloud revenue, which means that NVIDIA's chips are getting pulled into the market, right? That's how that's being facilitated. So.
All right, so you've been on the sidelines with NVIDIA. You haven't stepped in. You had some concerns about maybe it's too pricey, but you want to play the AI theme, Lou. So where else would you be looking?
I think the more reasonably valued is Microsoft. I mean, you got to do your own due diligence, but the key difference with Microsoft, they can push AI into the market, right? They're creating products, therefore they can create the demand. NVIDIA is getting pulled into the market. I think Apple's the sleeper AI
Now that's interesting. Apple is sleeper because Apple is right now. We've actually talked about this. So Apple's kind of perceived as they missed the boat, right? Everybody, the race is on. They got left behind. You don't see it that way.
I don't, and look at Tim Cook's history, right? Everyone thought he was going to miss the boat after he came in to replace Steve Jobs, and he continued that tradition. They're never first or second to market. They come in later, but then they come in late, but they end up being the leader. And here's the key differentiator for Apple. They have 2 billion active devices in use. Yeah. If they just iterate and add a little AI somewhere, it has a magnified impact on
big, loyal, satisfied group. And also, I always think with Apple, Tim Cook, he he controls the software, the hardware, the chips, right? It's that vertical integration. When he decides he wants to make his move, he can flip the switch quickly. Are you sort of looking ahead to that software show for Apple? Is that kind of maybe a catalyst you're looking to?
Yeah, I think that's the first step for Apple, but it's going to continually and perpetually underwhelm people, right? Apple's in that swing of sentiment where people just don't believe they're going to pull a rabbit out of the hat and become a leader again. I think this is usually when is the time to buy in Apple. Historically, full disclosure, I do own it. Firm doesn't. We don't do any investment banking. But if you look now in the middle of the doldrums of summer approaching, ahead of holiday season, has historically been a good time to time the market.
Seasonality works for Apple during the summer. Well, all right, so Nvidia too expensive. Any other chip names you find attractive?
I really think ARM Holdings coming back to markets, re-IPOing as a public company is attractive. They give you leverage to whatever the next semiconductor trend is. They're branching into AI pretty aggressively. They have a recurring revenue model that's much more attractive than a one-off sales model than Nvidia. I think if you want to go small,
you're obviously saying too, you think that valuation is more attractive to you.
It's a little bit ahead, but I think it's going to grow. You're going to see the growth, just like Nvidia grew into its valuation. I think ARM has the potential to do that. It's just a newly traded company again, right? It got taken off the market. If you want to go, I like tangible AI applications. So, and this is full disclosure, we banked it. I don't own it, but the firm does. It's Heartbeam. So this is a portable credit card sized device that can detect heart attacks, and their latest data came out that they can do it better than human cardiologists. So I get more excited about small cap, undervalued names that are really innovating and practical applications of AI. And I think that's what's really going to have the biggest gains, because we're going to see how AI really impacts our life, saving lives versus helping our kids, save a few grades by cheating on it in school, right? I mean, this is that doesn't have a long, sustainable business behind it, but other applications do.
Yeah. Lou, always love having you. Strategy picks. Thank you.
Thank you.
Appreciate
Always.
it. More on Nvidia earnings after this, when asking for a trend returns. Nvidia shares are nearly 3% higher here in the after hours following those earnings. Jared Blickery joins us now to check in on how the numbers are impacting the rest of the markets. Jared.
Josh, we almost had $1,000 for Nvidia in the aftermarket, and you can see right now it's only at 974.87. That is good enough for a 2.66% increase over the closing number, and that number that we got only minutes ago was 949.50. Now there are about 2.5 billion shares outstanding. So if you do the math at $1,000 per share, you're going to end up with a valuation of $2.5 billion. So still not to $3 trillion. Like Microsoft or Apple was prior, but inching up there. So I thought it was really interesting to see the commentary. Gross margins just knocking it out of the park. The actual beat for the current quarter, for the reporting quarter, not as big as people might have liked, but nevertheless, it's all about the forward guidance. And I should say something about the stock split as well. 10 for 1, that's going to happen on June 7th. As we've talked about, typically a stock split or a reverse split, that's where shares are increased, isn't supposed to really affect the bottom line of the company. It's just a mathematical exercise. But this does make this very expensive stock, $949 or $978, depending on your quote. That's going to be brought down to $94, $97, $98, $100. So that will also put it in candidacy for, in addition to another index. I'm not going to throw the name out there. I don't want to start rumors, but typically you do want to have those lower price tags for these consumer-facing stocks, and that's what Nvidia now is. It's a poster child for the AI revolution. Now, let me check in on some of the other semiconductor stocks that are trending here, and you can see the background colors here. Those represent what happened during the day. It's those little rectangles that show you what's been happening in the after hours. I should point out that Supermicro up 1.8%, ARM up 1%, so there's a lot of follow-on trading here as well.
Thank you, Jared. Nvidia shares rising after reporting first quarter earnings. The chip giant beating on the top and bottom lines. Revenue coming in at $26.04 billion. That's versus the estimate of $24.69 billion. Adjusted earnings per share, they clocked in at $6.12. On top of all that, Nvidia also announcing a 10 for 1 stock split and raising its dividend. Joining me now is Gil Luria, Managing Director at D.A. Davidson. So Gil, great to see you. So listen, Nvidia reports they beat. They offer another bullish sales forecast. Jensen Huang here, Gil, saying the next industrial revolution has begun, in his words. Give me your take on the print, Gil, your reaction.
No, it's a great result. Expectations were high because they keep setting them higher, and they still exceeded them, both for this quarter and their guidance for the next quarter. But it shouldn't be too surprising. Their customers told us they were going to spend more. Microsoft, Amazon, Google, Meta told us they were going to spend more on GPUs. They told us they're buying any GPU Nvidia will sell them, and that should continue for the rest of the year. Those companies were very clear about the fact that they're in an arms race. They're in a land grab to have as much generative AI capacity right now as they can buy. And that bodes well, not just for this quarter next, but for the rest of the year for Nvidia, because they have all that demand lined up.
And Gil, just looking ahead now, if you're an Nvidia investor, you're excited. New GPU platform, Blackwell on the way. What is that going to mean for the company, for its business, financials?
Well, so the innovation at Nvidia is accelerated. They're now introducing a new product set every year, and they have to, because competition is now building products that are more and more comparable to what Nvidia does. And importantly, those customers that I listed are all building their own chips. They're all saying that inferencing will increasingly be done on their chips, whether in a data center or on a device. And that's what you have to start thinking about for next year and the year after that, is that their customers at some point are going to have enough NVIDIA GPUs, A, because they'll have enough data center capacity, and B, because they're going to be putting their own chips in the data center. So those are the things to look out for as you get past this year. But a lot of this stuff is not going to happen this year. Those companies told us so.
And Gil, most of your colleagues on the street, Gil, 90% telling me I should buy Nvidia. You don't. You say, you're neutral. You just mentioned some of the potential challenges ahead. Are those why you're on the sidelines, Gil, or is it an evaluation call here?
No, that's exactly why, because I have the street low number out of 50-something numbers for 2026. I actually think that the revenue growth for 2026 will be negative, where most of the estimates are for pretty substantial growth into next year and the year after that. To us, what I just said in terms of their own customers competing with them, their own customers reaching a point of saturation at some point, means that there's going to be a point next year where revenue starts declining sequentially. When that happens, the estimates are going to have to go down very substantially. Hard to recommend a stock when you expect that to happen as soon as next year.
So when you talk to clients, though, Gil, they ask you, okay, what are some upside risks to that call? What do you tell them?
That if applications start catching on at a faster rate, if we get more and more killer applications that depend on data center GPU capacity, then NVIDIA will be able to keep ramping for the next few years because those large customers will need more and more capacity. We haven't seen that yet. We have some great, interesting, promising applications out there, but none that have caught on, none that are commercially viable beyond testing, experimentation, and hope. Until we see some of those applications generating real substantial demand for Microsoft, Amazon, Google's customers, there's not a lot of reason to think that they'll have to continue to ramp up their data center spend into next year and the year after that.
And so, Gil, I am interested, if valuation isn't attractive here, if it's not supportive in your opinion, what is fair value, Gil, in your opinion?
Well, it's a tough situation, right? Because what I'm describing is next quarter is going to be great. The quarter after that's going to be great. And they're only trading at relatively comparable multiples to historical levels. So valuation, if you believe NVIDIA will continue to grow into next year and the year after that, valuation is not unreasonable. If you believe, as we do, the 2026 results will have sequential decline and the business will converge toward more of a run rate, then valuation actually could end up being very, very high right now.
Gil, I like it. You're sticking to your guns. Appreciate you coming on the show. Thanks so much.
Thank you.
Coming up, we'll continue to recap the latest numbers from NVIDIA and dive into a few other earnings reports from Snowflake and Elf Beauty. Stay tuned. Asking for a Trend continues next. Nvidia's done it again. Chip giants blowing past analyst expectations in its strong fiscal first quarter. The chip giant beat on the top and the bottom lines. Revenue coming in at $26.04 billion. It's versus the estimate of $24.69 billion. Adjusted earnings per share coming in at $6.12. Company also gave another bullish sales forecast showing that spending on AI computing is paying off. Second quarter revenue will be about $28 billion. Analysts have predicted more like $26.8 billion. On top of all that, Nvidia also announcing a 10-for-1 forward stock split and raising its dividend. Julie Hyman, Dan Howley are here with the takeaways. You know, guys, you went into this print and everybody was on the same side of the boat. 90% of analysts say to buy it. You know what? Sometimes the herd can be right, Dan Howley.
Yeah, I mean, look, I think I'm just looking at this now, not for the first time I've been poring over this, but I just want to quickly, very, very quickly point out that obviously the data center business, easily the most important, but I just want to go over the gaming business real quick because now they're referring to it as gaming and AI PC. And if you've been following what's going on with Microsoft, Qualcomm, Intel, AMD, they're all talking about this new generation of PCs, AI PCs. Microsoft, I was just in Washington, had a big event for this. Now Nvidia pointing to AI PCs. They want to get in on that action as well. Big partner with Microsoft, but the gaming business, not the most important. It's clearly a data center. And I just want to point out the revenue share for the company. 86% of the company's total revenue for the quarter came from data center revenue. This is a company that was all about gaming cards just a few years ago.
Yeah, remarkable.
Yeah, you go back to 2021, less than half of that was the share of the total revenue pie, as we talked about earlier. So it's pretty incredible. You mentioned the gaming there, and I was interested to look at the sequential change in the various segments here. Data center obviously up huge year over year, more than 400%. Quarter over quarter up 23%, still quite respectable. Networking revenue was down 5%. Gaming revenue up year over year, down quarter over quarter by 8%, and they blame that on seasonally lower GPU sales for laptops. Professional visualization, that's another part of the business, down 8% quarter over quarter. Auto, another bright spot though, up 17% quarter over quarter. So that one, just, it's interesting to look as we see this big growth. What does it look like quarter over quarter? What kind of momentum is there behind some of these businesses?
Yeah, for sure. You know, Dan, I was thinking about how heading into the print, we were talking about some of the threads, the themes, and we were talking about, listen, everybody we knew was going to make a beeline for the data center as soon as it hit. And there was this sort of narrative building out there, well, what if, because you had new GPU platform Blackwell on the way, and maybe customers, they delayed, they paused, because they were waiting for the shiny thing. It didn't look like that happened.
Doesn't seem like that's happening, and I guess, you know, they're projecting these the revenue for the next quarter at $28 billion plus or minus 2%, which, you know, knocks out the 26.6 that analysts have been expecting. The Blackwell chips aren't going to come out until the end of the year, right? So that's something that I think you start to look at. Okay, well, if they're continuing to see this kind of revenue, what does it mean when, you know, the big shiny thing comes out, the big shiny more expensive piece comes out? And, you know, one of the things that that during GTC that Jensen had really kind of pushed was the new Blackwell, the GB200 chip. That's the two Blackwell chips and the Grace chip kind of all merged together into the super chip. That's going to be pretty pricey. So you got to imagine that when that starts to sell, where's the revenue going to go from there?
And one more thing that we noticed in the release here is that Jensen points out who are the customers for a data center, which is important here. He talks about that beyond cloud service providers, generative AI is expanded to consumer internet companies, enterprise, sovereign AI, automotive and healthcare customers. He says creating multiple multi-billion-dollar vertical markets. And as Dan and I talked about off air, that's important because there was concern maybe that they were too reliant on the so-called hyperscalers.
Too concentrated. Jensen saying we serve a lot of people.
Yeah, but Colette Kress, the CFO, in her statement saying still 40% of that data center
chunk
revenue is those hyperscalers.
Those cloud giants. Thank you guys both so much. Appreciate it. Let's take a look at what's trending after hours here. Shares of ELF Beauty, they are sinking here after projections for the cosmetics company's 2025 fiscal year came in lower than expectations. ELF seeing net sales for 2024 coming in between $1.23 billion and $1.25 billion. That was below estimates $1.28 billion. That's what the Street wanted to see. For the fourth quarter, ELF beat expectation on the top and bottom lines. Adjusted EPS of 53 cents came in higher than the 33 cents analysts were anticipating. Meanwhile, Snowflake shares, they're rising here in extended trading after the software company reporting first quarter results that beat expectations and raised its full year forecast for product revenue. For the first quarter, Snowflake reported revenue of $828.7 million, which rose 33% year over year. That did top estimates of $786.3 million. And looking at Q2, the company sees product revenue between $805 million and $810 million, exceeding estimates of $787.5 million. And check out shares of DuPont. The stock soaring on news of the company. It is going to split into 3 companies. The conglomerate is going to separate electronics and water divisions. It's the latest industrial giant to make that move to try to boost returns after a similar move from General Electric. That's going to do it for today's Yahoo Finance. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.